Hello all of you, I hope you all are doing good. Today we are going to revise accounting standard 10, that is property, plant and equipment. Very simple accounting standard but little bit lengthy accounting standard because previously there was accounting standard 6 which covers the depreciation. Now depreciation is also part of accounting standard 10 now. So what is going to happen, even the name of accounting standard is property, plant and equipment, but we are going to cover property, plant and equipment, and at the same time depreciation on PPE as well, covered by accounting standard 10. So there are so many things, as you can see that, but very simple, don't worry. You can see that a long list of items that we are going to cover. Okay, so many. So no problem, total 31 points. Okay, let's start with first point, that is introduction. Okay, now listen carefully. So what is going to happen, as you can see that the name of accounting standard 10 is property, plant and equipment, which deals with the accounting of PPE. So instead of calling property, plant and equipment, I will call PPE. Okay, so accounting standard 10 covers the PPE, and they say that here, but there is one exception that here now. If another accounting standard mandates a different treatment, example AS9 lease, evaluate lease PPE recognition based on risk and reward, no depreciation, follow AS10 practice. What does it mean that here now? Accounting standard 10 talks about the accounting treatment of property, plant and equipment. But they say if there is some accounting standard and they talks about some specific treatment, for example, that here, if you have taken something on lease, that is also PPE, you have taken some machinery on lease that here. So what is going to happen? The treatment is going to be done as per accounting standard 19, that is lease that. Okay, if there is some separate accounting standard which talks about some under certain specific situation like the lease that is, so we'll follow that. But AS19 talks about that here, recognition of lease. I said that we have taken on lease, but for depreciation purpose we are going to follow AS10 only. So to make it simple, that here AS10 deals with property, plant and equipment, tangible items, and this is accounting standard 26 which deals with intangible. So here we are going to cover only tangible items. Okay, so let's start. The first question arises that what do you mean by property, plant and equipment? Because when I see my balance sheet, suppose this is my balance sheet, and here on balance sheet, suppose this is my balance sheet that here, and here in balance sheet on asset side that here, I see a PPE. So basically it deals by accounting standard 10. So what do you mean by property, plant and equipment? So they tell us that here now, a property, plant and equipment means an asset which is tangible. Tangible, what does it mean? Tangible, something that we can touch it, that is tangible, which held for use in the production. Can you give an example that here? Okay, that is that we held for use in the production. So for example, that here machinery. So I am using machinery for the purpose of what? Production that here. Okay, or supply of goods or services. So we are using it for supply of services. For example, delivery van that here. So we are using that here, a delivery van that here to provide the or to delivery of the what? Goods. Or certain time that is something we use in the production like the machinery or supply of what? Goods or services that is. So what is the first condition? It should be tangible and which we held for use in the production, not for the purpose of resale. If something we held for the purpose of resale, then it is going to be deal by accounting standard 2, that is inventory here. But here we are talking about this which we held for the purpose of production, supply of goods or services or rental to others. It might be happen I have something, for example, I have taxis. Okay, taxis we are giving them on rent. It's a PPE. Okay, for the service provider that here. Or for administrative purposes, example that here furniture that here. Example furniture. So it says that here now, a PPE means some asset which is tangible, which is held for use in the production, supply of goods or services, rental to other, or for administrative purpose, and expected to be used for more than how many months? Expected to be used for more than how many months? 12 months. Obviously, if the life is less than 12 months, we are going to directly charge to profit and loss account. Okay, so it's the capital expenditure that here, and the life obviously is more than 12 months, and over a period of time we will charge you to P&L account in the form of depreciation. Okay, this is PPE. Remember that. AS26 deals with intangible item that AS10 deals with only with tangible items that here. Now this is one point important, PPE for safety or environmental purpose that here. What do we mean by safety or environmental purpose? They say that here certain time it might be happen that here, for example, for the safety purpose we are using something that here, okay, that we are not using for the purpose of production, supply of goods or services that here. So someone may argue that, sir, if you are not using for production, supply of goods or service, rental to other or administrative purpose that here. That is not PP, but remember that it might be happen certain time we are using something to safeguard the other asset. For example, fire extinguisher that here. That we are using it for the purpose of what? To take care of the safety of other assets so they can perform. Okay. So these and for safety purpose asset PP is also going to be recognized under accounting standard 10. So this says that here now. What we pencil. Okay. Now they say PP acquired for safety or environmental reason. Okay. Okay. Is it okay? Blue color or should I change it here? Blue. Red is okay. Okay. For safety or environmental reason, qualify as an asset supporting future economic benefit from the related asset beyond what would be possible without them. So we're using this safety purpose instrument to safeguard the other asset. Example. A company acquired a fire extinguisher for safety reason and the fire extinguisher are recognized as asset, ensuring the safety of person and protecting other assets from potential fire damages. So these fire extinguisher is PP. Then it says that, chemical manufacture, that is for environmental reason also. So we may acquire certain PP for the purpose of what? Environmental. So they say, they say, and chemical manufacturing install a new machine handling process for environmental compliance in handling hazardous chemical and plant enhancement are recognized as what? Asset. Crucial for the ability to manufacture and what? Sell chemicals. So they say that here, it's a chemical company, they're doing the manufacturing of chemical. So to safeguard the environment, its compliance, they purchase some chemical handling process, okay, machines. So that is going to help them to basically here the plant enhancement are recognized as crucial for the ability to manufacture and what? Sell chemicals that is. So that is basically that they purchase certain some chemical handling process, new machine that they have purchased for what purpose that here? To handle the hazardous chemical. Okay, so that is for the purpose of environmental. Okay, so it is also PPE. Now, very important point that here, accounting standard 10, they say applicability. When we talk about applicability, what it says, it is not applicable to first, listen carefully. It is not applicable to biological asset other than bearer plant. Please remember that here. They say it is a first not applicable. So what do you mean by biological asset? I will discuss with you. But they say not applicable to biological asset other than bearer plant. So bearer plant is an exception of exception. To make it simple, it is not applicable to biological asset, but it is applicable to bearer plant. AS10 is applicable to bearer plant. Now question will come in your mind. What do you mean by biological asset? What do you mean by bearer plant? I will come to that here. Okay. But remember that AS10 is not applicable to biological asset, but it is applicable to bearer plant. Okay. And it is also not applicable to wasting asset, including mineral rights and exploration or extraction expenditure for mineral, oil or natural gas, etc. Okay. So applies to bearer plant. Okay. I will come to bearer plant, but not to their produce. First, you have to understand what do you mean by biological asset, what do you mean by bearer plant, and what is this note that here applies to bearer plant? Yes, we know that accounting standard 10 is applicable to bearer plant, but it is not to their produce. What does it mean? I will come to that. But before that, you have to understand what do you mean by biological asset and what do you mean by bearer plant, because AS10 is not applicable to biological asset, but it is applicable to bearer plant. So what it says that here now, first of all, what do you mean by biological asset? So AS10 is not applicable. AS10 is not applicable to biological asset. Okay. So what is biological asset? The living plant or animal. So if someone is using horse, okay, for the purpose of delivery of goods, they say it's a PPE, it's tangible, sir. Yes. You're using it for the purpose of what? Providing services. Yes, correct. And you say that when now they say life is more than 12 months. So whether the AS10 is applicable, the answer is no. They say AS10 is not applicable to biological asset, means living plant or animal. Okay. But it is applicable to bearer plant. So what is bearer plant? They say bearer plant, it is a plant that satisfies all the three conditions. How many conditions? Three conditions. So it satisfies all three conditions. What it says is used in the production or supply of agriculture produce. I will tell you that we are using that here, that plant for the purpose of agriculture produce. Now imagine orange tree in your mind. It's a tree which producing agriculture produce this orange. Okay. Then they say is expected to bear produce for more than 12 months. What is the life of the asset? This plant is more than 12 months. That is okay. So that orange tree is going to produce the agriculture produce. Example orange. How much is the life of that orange tree? More than 12 months. And has a remote likelihood of being sold as a agriculture produce. Obviously, we are not going to sell this orange tree. We are going to sell what? The oranges. You got the point that here now? It's a bearer plant. To make it simple that here now, you might get confused at a certain time, but they are not going to ask you in depth. But still, I am telling you that you might get confused that when to call a bearer plant and when not to call it particular plant bearer plant. Let me give you an example. Remember that if something, listen carefully, if something you are selling by picking from the root of that plant, then that is not a bearer plant. Like the vegetables that here, they are not a bearer plant. If any vegetables that here, if you're picking from the root and we're selling them, that is not a bearer plant. Because one of the conditions of the bearer plant that here, you are not going to sell that particular tree. Anyone sell that orange tree? No. What they are going to sell the oranges that here. It's a bearer plant. You got the point. So what are the three conditions that here now? Bearer plant basically we are going to use to produce the agriculture like the oranges. The life of the plant is more than 12 months that here now, and we are not going to sell this orange tree as the agriculture produce. Okay, so oranges we are going to sell, not the orange tree. Okay, so examples we are given: the orange tree, apple tree, rubber tree, etc. But remember one very important point: when bearer plants are no longer used to produce, they might be cut down. So it might be happen in future that I am not using that plant to produce agriculture produce. We may cut down and sold as what? Scrap. For example, used as firewood, such incidental scrap sale would not prevent the plant from satisfying the definition of what? Bearer plant that here. So what does it mean that here? They're telling us that here, even though it might be happen that in the future we have to cut down the tree and sell that, but that does not mean it's not a bearer plant. For us, still it is going to be called as what? Bearer plant. When we will cut it down, that's a different thing we are going to de-recognize from the books of account, but still we are using it, okay? We are going to call it what? A bearer plant. Now, we discuss about what to mean by PPE that here. Okay, now PPE is a tangible item held for use in the production, supply of goods or services or rental to other or for administrative purpose. An expected usage life is more than 12 months. We call them PPE. When should I recognize in my P&L account? When should I recognize in my balance sheet, in my books of account? They say recognize if probable future economic benefit. What do you mean by future economic benefit? Remember that future economic benefit does not mean only revenue is going to increase. Okay, it might be happen we use some PP that is going to help me to increase the revenue. It might be I'm using this mic. It helps me to generate the revenue that here. Okay, now what is going to happen that now? But it also might be happen that here because of the PP, my costs go down. For example, you purchase a machinery, you say now there's no need for the 10 employees. You fire those 10 employees, then you purchase a new machinery. So that cost also going to reduce because you're not going to pay the salary to those 10 people that now. So they say it might be a probable future economic revenue should be increased or cost might go down. Okay, so cost of item can be, yes, obviously second condition, cost of the item can be measured reliably, then only we can recognize in the books of account. Now the question is what do you mean by cost that here now? Okay, so to make it simple for you, this book will help you that here, very simple that here. Just remember this table that here. The first is the purchase price paid for acquiring the asset. But remember that if any discount that here now, they say any discount or rebate, then we have to deduct. Now what we'll do that we'll add that duties and taxes only if non-refundable. What do you mean by non-refundable that here? If they're refundable. Now you know about the GST that if you are going to claim the input GST, that cannot be part of the PPE that here. Okay, this is only non-refundable, which you are not going to take the refund from the government, or you are not going to claim as an input GST. Okay, so those taxes will be part of the cost of the PPE. Now they have given duty like the stamp duty, registration charges, purchase tax, import duty, all are the examples here. Okay, now we'll add them. Now they say any other directly attributable cost of bringing the asset to working condition for the intended use. If you want, you can write it down that here in the manner intended by management. In the manner intended by management. Now listen carefully. This is any cost that we have incurred to bring the asset to their present location, to bring the asset in the working condition in the manner which is intended by the management. So let's take an example that here. It's the employee benefit cost related to construction. We are doing the construction of the office building. So we are paying wages that here. So that is a part of the cost of the PPE that here. Now they say here now here the site preparation. Before we do the installation or the construction of a building, we have to do the site preparation that here. Okay, then the initial delivery and all these costs were incurring before the asset is ready in the manner which is intended by the management that here. Okay, now installation and assembling cost also testing, trial runs also. Okay, trial runs. We are doing the trial run of that particular asset that. But they say if any revenue that we have from the proceed of any sample that any revenue, okay, any revenue from the sample that year. So I'm doing a trial run that year, okay, but they have some sample of those out of those trial run, and I make some. So then we sold those samples. So we make some amount. So whether those income is going to charge to P&L, credit to P&L account, they say no, less from the sale proceed of any sample that year. Okay, let's what sale proceed of any sample. Those sale of the sample is going to reduce from the cost of PP. Okay, professional fees that here now, consultant, legal, architect fees that here all are related to that particular PP. For example, we are doing the construction of building that here, so we pay the professional, the consultant, the civil engineer, architect, okay, legal advisor. Okay, and now salary of supervisors engaged in the construction or installation. Why salary in general is not a part of the cost of the PP, but why we are adding the here to the cost of PP? The reason is that a salary of supervisor who is engaged in the construction installation. Now, this is also important. Depreciation on asset used for the construction or installation. Suppose I have one PP I am using to do the construction of another PP. So depreciation of these PP that I am using it for the construction of another PP is also added to the cost of another PP. The logic is that here now. It's a revision lecture. I can say so many points here, but the logic is that here, if this asset I'm using to create another asset, the depreciation should be added to the cost of another asset, because this asset is not helping me to generate the revenue. So no logic to charge the depreciation of this asset one to the P&L account. Okay, they are not generating revenue; they are generating another asset and the cost of depreciation to the another asset. Okay, now the last one is the present value of dismantling a site preparation cost that here now. Now what happened at certain time it might be happen that I am to use this particular machinery for 10 years. But for example, law says that we have to do that particular place. I have to dismantle a site restoration that year. So I have to dismantle that machinery after 10 years, suppose. So what is going to happen? I am to incur the cost not today, after 10 years. Okay. But they say I'm incurring after 10 years, suppose 10 lakhs rupees. Now, hypothetically, suppose that today's present value is just 4 lakh rupees. So they say record at the present value of today, add to the cost of the PP. So what is going to happen? This is the estimated cost of what I'm going to incur, in our example, after 10 years, multiply by the present value factor, then we have to record it. But don't worry, the detailed accounting of that here, because after 10 years, suppose we have to pay 10 lakh. Today their value is suppose 4 lakh only. So what about the remaining 6 lakhs? So don't worry, we have to create a provision in accounting term. We call them unwinding of discount, and this unwinding of discount is covered by accounting standard 29. I will cover there. But for the purpose of this depreciation, this PP, just remember that present value of that dismantling cost we have to incur after example 10 years. We have to record at the present value, and then we have to do the total of it. That is the cost of the PP, and this is a favorite question of ICI. Okay. They ask question on this. Okay, now so many points. Now listen just carefully. Then they say that here now, in silent situation, assume all duties and taxes are non-refundable. Okay, ignore profit or material or service internally used in the construction of PP. For example, now department is supplying the material to department B at a profit margin. So that profit will not be added to the cost of PP. That is because within the company. Incidental operating during operations during PP construction development. Example, incidental operations such as earning income from a building site used as a car parking before construction are recognized in profit and loss account, since they are not essential for bringing the item in the manner which is intended by the management that here. Now please understand this point that here. They say basically if any income, for example, this is construction is going on here, okay, but I have some space, so I give them on parking, but I make some income from them. That income should be part of the P&L. It will go to the P&L account, because this parking revenue is not helping me to generate the to create the asset. So that income will go to profit and loss account. Now here it will go to P&L account, but selling of the sample that we have created out of the trial run, that we reduce from the cost of the PP. Now treatment of spare parts, standby equipment, servicing equipment. If they meet the definition of PP, it will be recognized under AS10. Otherwise, it will be treated as inventory under accounting standard 2. Now here accounting standard 10 specifically says that these 7 items is not a part of the cost of the PP. First, not a part of the cost of the PP. First is the relocation or reorganization cost. For example, if we are moving from Chennai to example Bangalore that here. So when we are relocation of the asset we are doing, whatever cost we are incurring for the relocation that is not a part of the cost of the PP. Advertisement and promotional activity, inauguration cost of opening a new facility. Now conducting business in new location or with a new customer. So we are doing the staff training because the new PP, okay. So that staff training cost is not a part of the cost of PP. Now, cost incurred while an item capable of operating in the manner which is intended by. Now, asset is ready to use in the manner which is intended by the management. But this is one problem. What's the problem that here? It is not yet brought into the use or is operated as less than the full capital. That is our problem. If asset is ready to use in the manner which is intended by the management, that's all. That's it here. So that is the end of that. Now after that, you cannot add any cost that you have incurred to the cost of the PPs. They say, even though I'm saying I'm not working, this machinery is not working at the full capital. Still, if it is not working at the full capital, you cannot argue that still if any cost incurring that will add to the cost of the PP. No, it already came into the position which is intended by the management that here. Okay, so we cannot recognize anything after that. This is administration general overhead not directly attributable to bringing the asset. For example, salary. Salary if related to this. Salary if related to what? Is the supervisor that here. Supervisor engaged in the construction installation. That is different. That is the cost of the PP. In general, salary is not a part of the cost of the PP. Any initial operating or loss also not a part of the cost of borrowing cost. Now remember that here, when we will cover accounting standard 16, I will tell you that rarely it might be happen that if the asset is a qualifying asset, then the borrowing cost is going to be part of the cost of the PP. Otherwise, no. So don't worry that here. In general, the borrowing cost is not a part, like the interest that here, example, is not a part of the cost of the PP. But there are certain exceptions if it is a qualifying asset as per accounting standard 16. So I will cover in AS 16 that here. But in general, remember that here, interest is not a part of the cost of the PP unless it is permitted by AS 16. Okay. Now we have recognized the PP. The subsequent cost, we have recognized the PP, but later on we are incurring some other expenses. So it is divided into three categories. First, day-to-day service, like the service. You purchase a car, so we are feeling now, for example, that you purchase a car, maintenance cost of the car, repairing cost of the car. Okay, that is not a part of the cost of PP. That will go to profit and loss account. We call them repairs and maintenance. Replacement of PP part. Now remember that. Suppose this is Indigo. Flight that here. Okay. Now, as per suppose these chairs, these seats that they have here, they have to replace it in every 5 years that year. So what is going to happen when there is a concept of, I will tell you that here later on when we come to the depreciation part that here, there is the concept of, yes, component method of depreciation. I will discuss with you the component method of depreciation. But remember, suppose this is aircraft, I'm going to replace these chairs after 5 years. So whatever the WDV of these chair, okay, I'm talking about these chair. Okay, WDV of these chair. Okay, derecognize. Derecognize means it is going to remove from the books of account, and here CM is carrying amount. Carrying amount, not chartered accountant. Okay, carrying amount will be recognized of new. For example, suppose the book value of the old shares is, let's say, the 1 lakh. So we are going to derecognize from the books of account. So we are going to pass P&L account debit to this PP account. Now you purchase a new asset, so new chair. So that new shares, PP account will be debited to cash or bank account. So old shares, let me write here old shares. Old shares, the WDV derecognize, new shares, carrying amount, book value means carrying on the whatever the price that you have, that will be recognized. So they say the cost of replacing part is recognized in the carrying amount when the incurred if recognized criteria are met. Carrying amount of those part replaced is what derecognize that here. Okay. Now same treatment we are going to go for the same treatment we are going to do for regular major inspection, like in case of aircraft. Same treatment like this replacement of PP. So if any WDV, the whatever the value of the previous regular major inspection, that will be derecognized. A new cost that will be incurred for the purpose of major inspection, that will be recognized to the cost of same treatment like replacement of PP. Okay. Now remember that here now. According to AS10, the derecognition of PP component is mandated. So we cannot give the excuses. No. We don't know that the item that we have to derecognize, like the chair, what is the WDV book value of that? No, you cannot give excuses. They say it is mandated, irrespective of whether the cost of the previous part or inspection was identified during the acquisition or construction. In cases where the determining the carrying amount of the replaced part or inspection is impractical, not possible for me to find it out in these aircraft, the total book value, how much belongs to this particular chairs, how much is the book value of this particular chairs, not possible for me. Suppose, so they say AS10 allow the user some other way to find it out their value, like the replacement cost. If we replace the same today, how much value I will get that here? Okay, that will be considered. Accordingly, you have to say if I replace it today, how much I will get that year. Then estimated cost of the future similar inspection, like in the case of inspection that year. If I do the similar inspection future, what is the value today and what would be the value in the past? So accordingly, make certain estimation, decide what is the book value of that particular item that you are replacing here. If it is not possible to find it out, okay, in that case you have to find it, but you cannot give an excuses. It is not, I'm not in a position to find it out the book value of the item that I want to replace. You have to de-recognize that. Okay, now I'm coming to part measurement. So initially every PP is going to record at what cost that is, but later on that on every balance sheet I have the option. I'm either to follow what the cost model or the revaluation model. So I will come to revaluation model, but before that, what do you mean by this cost here? In case of a cost, initially we have to recognize that cost, and you all know that what do you mean by cost, because we have already discussed what do you mean by cost. Okay, so I will record it cost that here. Depreciation we are going to deduct that here. Now any accumulated impairment loss which is dealt by accounting standard 28 that year. Okay, so later on I will discuss with AS standard if there is an impairment loss that also will remove from the cost, and then this is the carrying amount with the book value. Okay, now what is impairment loss? Don't worry, I will discuss with you in AS 28 that. Okay, now but when it's come to revaluation model, I have the option. Okay, I have the option that at the end of the year, so when I finalize my books of account, when I finalize my balance sheet that here, I have the option to follow the revaluation model. What does it mean that here? Revaluation model means that something which is recognized in my books of account. For example, the land and building is appearing at 10 crore rupees. But do we have the option that here, if suppose the book value of the land and building is appearing at 10 lakhs, but the market value is supposed to 10 crore, I said, I think, okay, 10 crore, but the market value is 12 crore. So do we have the option to increase the value of land and building from 10 to 12 crore that year? Because it might be happen. The value which is appearing in my books of account 10 crore, but the market value might be 9 crore that year. So do we have the option to increase the value, decrease the value in the books of account? The answer is yes, AS10 allows. So we call them revaluation model. So is it necessary to follow the revaluation model only? No, we have the option that here, either to follow the cost model or to revaluation model that here. So what it says by the revaluation model that here now, it says that here now, fair value at a date of what? Revaluation that. Okay, so any subsequent depreciation will be reduced from it, and impairment loss will also be removed from it that here. Okay, so but remember that here now when we talk about, we are going to at the fair value will recognize. Don't worry how to do the accounting of that here. When the value increases and the value decreases in the market, I will tell you. We'll discuss about the accounting as well that here. But remember that here now we have to recognize later on we have to recognize that fair value. Don't worry about the accounting, how to pass the journal entry. I will discuss with you. Now remember that when you want to charge the depreciation, you want to charge depreciation on revalued amount, and impairment loss, and that also is going to reduce from that. Don't worry about the impairment loss, that we will discuss in accounting standard 28. Now it is mentioned that they charge depreciation on what? Revalued only. So when you change the value, we are going to charge the depreciation on that revalued amount. Okay, the class of the PP that here now. So they say, can I follow different model for different assets, like the cost model for furniture, revaluation model for machinery? Sorry. Okay, is it possible for me to do that here? The answer is yes, we can do that here now. Okay, we can do that here now. But they say a class of the grouping of a similar asset that here. Okay, I cannot say for some furniture cost model and for some furniture revaluation model. No. There is a class for when you decide any model that is, but for that particular class, same we have to follow the model here. Okay, so they say class is the grouping of similar asset used in enterprise operation. Example include land and building, machinery, ships, aircraft, motor vehicle, furniture, fixture, office bearer. All the different classes that here. So for one class, you have to follow one model, either cost or revaluation. But for example, for the furniture, I can follow cost model, or for the land and building, I can follow revaluation model. Okay, but they say AS10 revised permits revaluation of assets on a class by class basis. Considering this is important, considering their function, nature, and general location. Now understand this. Generally, we believe that here now, for example, if I have a building. Now, factory building is that, and the office building. So you will say, so both are building, they come under the same class. No, their nature is different. You will say, why? Both are building. Now understand this point. What is going to happen that in one case, it's a factory building where production will go on that day. Office building, the office, like the chartered accountant, the staff will be there. So usage is different. So their function is also different that here. So they might come under the different categories. So office building is a different class, and for example, factory building is a different class that here. So in both the cases, I can follow any one case cost, in one case revaluation model. Yes, even though both are building, but their function, nature are different. So we can follow different methods here. Okay. Now, when we follow revaluation model, should I check Annually, yes. If it significantly changes or volatile changes, you have to check the we have to check the we have to do the revaluation every year. But if the PP only with insignificant changes in fair value, revalue the item only 3 or 5. It is not 3 to 5 years. Okay, this is 3 or. It means very rarely change. So do the revaluation in every 5. Sometime change. So do the revaluation in 3 years. No, very frequently change. So annually we have to do the revaluation. Okay. Now, so accounting treatment of revaluation, now we'll discuss that here. What it says, listen carefully. They say that here, it might be happen that is, suppose this is my land and building. So value, it might be happen, suppose my book value is 10 crore. So but the fair value might be 12 crore. The fair value may also go down, let's say the 9 crore. So this is in upward, we call them, this is downward, increase and decrease. How to do the accounting of that? Now listen carefully. So what it says that, I will read that here, but you will understand properly when I will cover this example that here. So it says that an increase in the carrying amount credited to revaluation surplus and recognized in the profit and loss statement if reverse the prior revaluation decrease. Okay. Decrease in carrying amount, this is charge to P&L account debited to revaluation surplus if it reverses the prior revaluation decrease. Now understand what does it mean that here. Okay. Understanding asset revaluation involves considering alternative where plus indicate an increase and minus indicate what? Decrease. Okay. Let's take an example that here. Now they say that here, the first time when I have done the first time, this is first time and this is subsequent second time. So what I mean, if all are 6 points, all are separate points. Okay. In first case, suppose the value increased by 5. Basic accounting, increase in assets should be debited. So I will say that your PP account will be debited by 5 and I will credit to revaluation surplus account. So what entry we have passed here? PP account will be, we don't have enough time as we are covering the revision here. So orally I'm saying that here now. The PP account will be debited to revaluation surplus account will be credited. How much balance I have in revaluation surplus? 5. Now in subsequent, it next again we have done the revaluation. Again the value increases by 4. So again increase in asset, I will debit, PP account will be debited and revaluation surplus account will be credited. Simple. Now second example, first year it increases by 5. So no problem. PP account will be debited, revaluation surplus will be credited here. Now how much balance you have in revaluation surplus? 5. Now it decreased, you can see the negative 4. Now it did decrease by 4. Short decrease in assets should be credited. So PP account will be credited. But which account we have to debit that here? Because previously we debited to revaluation, previously we credited to revaluation surplus. So we have the balance of 5 in revaluation surplus. Now the value goes down. We can adjust to revaluation surplus up to 5 because we have balance of 5 in revaluation surplus. So here I will pass entry that here revaluation surplus account will be debited by 4 and PP will be credited by 4 that here. You got the point that here now. This is the case. First time revaluation surplus, then value goes down. So credit in the revaluation surplus. I have enough balance. Now recognizing the prop, if it reverses the prior revaluation decrease that here. Now understand this here. So what is going to happen now? Now credited they are saying, okay, decrease in value. We are discussing that. This point, okay. So charge to P&L account. So these 4 you will say charge to P&L, but they say debited to revaluation if it reverses the prior. So priorly we credited to revaluation surplus. Now we are decreasing it that here now. So that's why we are to adjust to revaluation surplus only. So in general, when the value goes down, we debit to P&L account. But what is the exception that however, debited to revaluation surplus because we are reversing a prior revaluation result. So we have a increase of 5 previously. Now we are adjusting that here. So it is decreasing. I will adjust in revaluation surplus. Maximum up to 5 is allowed, but I am decreasing how much? 4 only because we have balance in 5 but decreased by 4. Now, third, again increase by 5. So PP account will be debited, revaluation surplus will be credited. That. Now it is decreased by what? Now it is decreased by 7. How much balance we have in revaluation surplus? 5. So how much we can adjust in revaluation surplus? Maximum 5. So what about the remaining 2? That will go to P&L account. So listen carefully. Here I am to pass entry. Revaluation surplus will be debited by 5. Profit and loss account will be debited by 2. And PP will be credited by 7. So you can see that revaluation surplus here by 5 and debit P&L by 2. Now in first time only it is decreased by 5. So what entry? Decrease in asset should be credited. So PP will be credited, but we don't have any revaluation surplus because first time only when we are doing the revaluation it decreases. So I am to pass entry. P&L account will be debited and PP account will be credited. Now again it goes on by 4. So we don't have any balance in revaluation surplus. So I will charge directly to P&L. So P&L will be debited. PP will be credited by 4. Now here 5. It decreases by 5. So decrease in asset trade. The PP account will be debited. P&L account will be debited and PP account will be credited. Okay. Now it is increased by 5. Now this is interesting that here. Now, first time in my first revaluation goes down by 5. So what we have done, P&L account debited and PP credited. Now it is increases by 5. So we cannot credit to revaluation surplus because previously it was debited to P&L. So we'll adjust in the maximum we can credit to P&L how much? 5. So this point that if it is increased, credit to revaluation, but in P&L account, if it reverse the prior revaluation decrease. So what we here it is increasing, but I cannot credit to revaluation because I'm reversing this prior which we debited to P&L account. So when value increases, maximum we can credit to P&L account by 5. So when value increases by 4, what is going to happen that now PP will be debited by 4 and P&L will be credited by 4 that year. Now this is very interesting. 6. First time it is decreases by 4. So what entry we are going to pass? P&L account will be debited by 5 and by 5 it is decreased. Sorry. P&L account will be debited by 5 and PP account will be credited by 5. But now it is increasing that year. So maximum we can credit to P&L by 5 only because previously we are debited by 5. So now we are going to pass entry PP will be debited by 7. P&L will be credited by 5 because we debited by 5. The maximum we can credit by 5. Now remaining will go to revaluation surplus like that. Okay. Okay. Now this is about how we pass the entry of the revaluation that year. Okay. Now treatment of the revaluation surplus. We'll see the questions on it. Okay. Now revaluation surplus. It is now the balance we have in revaluation surplus. It is mandatory to transfer the balance of revaluation surplus to that here now is to revenue reserve. It is revenue when it is mandatory that here now. When you de-recognize the asset, okay, when you sold the asset, when you remove the asset from the books of account, so whatever balance belong to that particular asset in revaluation surplus, we are going to transfer from revaluation surplus to revenue reserve account. Imagine the reserve and surplus account in your mind. So you have certain balance in revaluation surplus, you're transferring the balance of revaluation surplus to revenue reserve in reserve and surplus only. But mandatory we have to do that when we de-recognize any asset and whatever balance and revaluation surplus belong to that particular asset which we de-recognize. But we have the option, not mandatory, to transfer the balance from revaluation surplus to revenue reserve. When we have the option that here now, not mandatory, even though we have not yet sold the asset, still we can transfer the balance of revaluation surplus to revenue reserve. But how much they say allow? How to calculate that amount? We revalued carrying amount debt. We have to calculate the depreciation on the revalued because we have done the revaluation. That's why there's some balance in revaluation reserve. So we have to calculate depreciation on the revalued amount. How much would be depreciation if there is no revaluation? So revalued carrying amount of depreciation minus original cost of depreciation. So how much is the actual depreciation we have charged minus how much depreciation would be if there is no revaluation. So whatever difference is coming, that much amount we can transfer from revaluation reserve to revenue reserve. Both are a part of reserve and surplus. So no transfer to revenue reserve do not pass through the P&L account statement. So they are telling us when you're transferring from the revaluation reserve to revenue reserve, don't transfer through P&L. Okay, it means revaluation reserve account will be debited and revenue reserve will be account credit. Both are part of what? Reserve and surplus in my balance sheet. So it is not going to P&L account. In reserve and surplus only, one reserve is going down and one reserve is what? Increasing. Okay, now accounting for disposal of what? PP. When we sold the asset, profit or loss will go to profit and loss account. This is the cost model that here. Gain on disposal, credit to P&L account. It's a profit. Loss, debit to P&L account. Revaluation model, gain, credit to P&L, loss, debit to P&L account. Okay. But note, remember that here when you sold PP, that here whatever amount in reserve and in revaluation surplus for that particular asset we have, that much we have mandatory have to transfer from revaluation surplus to revenue reserve. So the credit balance and revaluation reserve, if any, which is unreversed, be transferred to revenue reserve, which is mandatory. Now, don't you think so that here now, it might be happen that here now, what is the subsequent changes of what? PP. What is the subsequent changes in PP cost? It might be happen that here now, we change the value. It might, because of some price changes that here now, changes in the tax law or changes in initial estimate, we estimate certain amount, estimate of the dismantling cost. Now AS 12 is going to come government grant that year. Okay, some changes in the price because of grant received from the government, whatever is the reason. If there is a change in the cost of the PP, what should the accounting treatment? Now see this chart that here. Now listen carefully. They say that here now, if we might be follow cost model or revaluation model. So what is the treatment when we follow cost model? That if the increase in liability, because of the change in cost, increase in liability. So PPE account will be debited, increase in liability, basics of accounting, increase in liability should be credited. Decrease in liability, if it says decrease in liability should be debited. So liability account will be debited, PPE account will be credited, but there is an exception. If a decrease in the liability exceed the book value of the PP, the excess should be recognized in what? Profit and loss account. What does it mean that here? Okay. Now listen carefully. I say this is my balance sheet. I have PP here. Okay. And suppose after charging depreciation that here, now suppose here, if it decreases in okay, after charging depreciation, suppose the value of the PP is suppose 3 only. Okay. Okay. Now the relevant liability of this related to these PPs appearing at 4, it might be happen the liability is 4, but because of charging depreciation, the value goes down. Now they say this decrease in liability that is now suppose the government say no need to pay this amount. So what is going to happen? So liability will be cancelled. So liability account will be debited by 4. But PP maximum how much we can credit it by 3 because the balance is what? 3 only. So remaining will go to profit and loss account 1. This is what they are saying. Now read carefully. If a decrease in the liability exceed the book value, what is the decrease in liability by 4? What is the book value? 3. Now the excess should be recognized in what? Profit and loss account. Simple. Now, if we are following the revaluation model, then we have to do the adjustment in revaluation surplus. They say increase in liability. Increase in liability should be credited. So P&L account will be debited and liability will be credited. Okay, but remember that here. What is the exception that here? That it should be debited to revaluation surplus to the extent of any credible existing revaluation surplus respect to that asset. It means if there is an increase in liability, so general entry we are going to pass entry P&L debited and liability will be credited. But if there are certain balances in revaluation surplus of that particular asset, so here instead of debiting to P&L account, we will debit to revaluation surplus. Now, if they decrease in liability should be debited. So liability account will be debited and revaluation surplus will be credited. But previously, if we have debited to P&L account, that is, then we have to adjust in P&L account only. So they say that exception here. Instead of crediting revaluation surplus, we will adjust in P&L account when then it should be recognized in the P&L account to the extent that it reversed the previous revaluation deficit on the asset. So previously, if we have debited to P&L account because of the revaluation that year, so previously now here instead of crediting revaluation surplus, we'll credit to profit and loss account maximum how much we have debited to P&L account previously. Simple. Now few more points related, little bit lengthy but small points. Just you have to listen carefully. Now here, acquisition of asset, non-cash or partly cash. What does it mean? We are exchanging asset that year, but I am giving you one asset in exchange. Either I am getting the amount partially and in the form of amount, in the form of some other. For example, I'm giving you this mic. Example, I'm giving this mic. In return, I'm taking some furniture from you. I'm selling you this mic at let's say the 20,000. Example. So I'm selling it at 20,000. And in return, I say give me the furniture and give me some cash. So how to do the accounting? What is the value? Because exchange is a non-monetary, partially or completely is non-monetary. So what does it mean then? There's the two criteria: transaction having commercial substance, transaction with no commercial substance. So what is going to happen that here now, when it's come to transaction with a commercial substance, they say cost measure. Okay, commercial substance. What do you mean by non-commercial means? It means if the exchange does not affect the cash flow or enterprise value. It means I'm giving you my example, BMW. Example I'm giving that. I'm giving a BMW of 50 lakhs. In exchange, you are giving me the Audi of 50 lakhs. I'm giving an example. So this does not affect the cash flow or enterprise value in the future. Right now, it is not affecting. In the future, it is the same thing. I'm giving you one machinery, you're giving another machinery, but both is going to perform same. Both is going to help me to generate the same amount of revenue that year. Okay, cash flow that year. So there is no commercial substance. Okay. So if there is no commercial substance, what should be the treatment? If there is a commercial substance, what should be the treatment? They say how to do the valuation. Cost measure fair value of the asset given up, unless fair value of the asset received is more reliable. So to make it simple, this is the order. First, fair measure at fair value of the asset given up, or measure at the fair value of asset received if the fair value of asset given up is unavailable. To make it simple, I'm going to record the fair value of the asset given up. I'm giving you. If it is not available fair value, I will recognize the asset fair value of the asset received. If both of them fair value is not available, then this is recorded WDV of the asset given up. They say last resort if 1 and 2 are not available. 1 and 2 are not available. That okay. Use WDV of asset given up last resort if 1 and 2 are not available. To make it simple, what's the first step? Fair value of the asset given, not available. Fair value of the asset received, both of them not available. Then WDV or asset of given. Okay. If in case of a commercial substance, if there is no commercial substance that here now, so what is going to happen? They say record at the fair value of the, no, sorry, the use the WDV, not the fair value, sorry, okay, WDV of the asset given, not the fair value, important point, okay. Here asset acquired, if does not have a commercial substance, same treatment, WDV of the asset given, okay, WDV of the asset, same treatment, okay, WDV of the asset given. The last part of PPE is that here PPE purchase offer a consolidated price. What does it mean that here now? This is the asset. I have purchased 4 assets. Okay. How much I paid for it? I paid, let's say that here I paid 50 lakhs for it. Okay. But there are 4 assets. 1, 2, 3, 4. I'm going to recognize separately for them. So I paid 50, but how should I decide that how much should I allocate that 50 in 1, 2, 3, 4? So they say look at the fair value of all these 4. Suppose the fair value of this 15, example 15, okay, 15, 15, 3 is to 2 is to 2. Okay, now 10, 10. So if I do the total 15 plus 15, 30, 10. Oh, again, it is coming 50 only. Okay, okay, let me change the figure that here. Okay, let's say 20, 20, 10, 10. Okay, 20, 20, 10, 10, 40, 60. So what is the fair value of the total asset? Fair value is total 60. How much is the cost? I paid how much? 50. So how to recognize this 50? You can see the fair value of individually 20, 20, 10, 10. So I will recognize in the proportion of 2 is to 2 is to 1 is to 1. You got the point? This is how so they say allocate. Okay. Now allocate the consideration to item on the basis of their what? Fair value at the acquisition date. So I will see the fair value individually. If fair value are uncertain, then we have to take the value from the competent values that here. Okay. So we ask to the valuer that what should be the fair value, and accordingly we are going to allocate. If fair value is not available, then sorry, we are going to ask to the valuer, and valuer will recommend what should be the value of these assets individually. This is what we discussed about the property, plant and equipment. What I will do that now, we will discuss about the depreciation, and then we are going to solve a question on it. Okay. Now we will cover depreciation. What do you mean by depreciation? So systematic allocation of depreciable amount over the useful life. So over the useful life of the asset, we have to depreciate, we have to charge to P&L account. So why is the depreciation? Because of wearing out, consumption or loss in value due to use, time or absence. So it might we are using it, so value goes down. Time passes, not necessarily we are using. You purchase iPhone today, keep it in the locker for 5 years. Then after 5 years, obviously you have not used it, still that their value will go down because of time and because of obsolescence, because of change in technology. Now note that here depreciation that here now is recognized even if the fair value of the asset exceed. You cannot say that here I'm not going to charge depreciation because the fair value of the asset in the market is more than the book value. No. Repairs and maintenance of asset do not negate the need to depreciate. You cannot say I'm doing the repairs and maintenance properly, so no need to depreciate. No, you have to do depreciation. And what do you mean by depreciable amount? Depreciable amount means the cost or the revalued amount of PP minus residual value. Now component method means suppose you purchase example that is one asset and different component have different life that here. So one component has the 5 years life, some has 2 years example, some has 3, some has 5 again. So what I will do that is I will depreciate these 2 part in 5 years only, and this I will depreciate in 2 years. This part I will depreciate of the same asset in 3 years. So what is going to happen that here now when you purchase an asset, so if it's like the aircraft that we have to take a proper bifurcation from the supplier. How much is the life of that particular part? This is significant part, not every small part. Significant is not defined, but generally it says that that part represent 10% or more than the cost of the total asset. Okay. If different life or different parts of the asset is different life, so we have to depreciate different parts separately that on the basis of the life of that particular part. Now they say the depreciable asset that is those who have a use some life. So characteristic use over a multiple period, limited life and need not for the resale. If it is for the resale, then it is an inventory. Example, plant and machinery, building and furniture. We don't charge depreciation on land because there is no life of that. There's a non-depreciable asset. Example, land, except item, okay, mines be taken for a certain period that year. That's a different thing. Okay. So land and building, we have to account separately because building is depreciable and building is depreciable and land is non-depreciable. So when you call it land and building, we have to know how much value belongs to land, how much value belongs to building. Now they say depreciation we charge to profit and loss account, but exception AS 26 allow inclusion, not just 26 AS example. Is 10 also. Do you remember that I told you that I'm using one asset to generate another asset? Depreciation of one asset is going to add to the cost of another asset. Same treatment given under the AS26 also. Now factor should be considered by a company while determining the useful life. So when we decide the useful life of the asset, what is the expected usage capacity based on the capacity or output? For example, how much this machinery is going to produce. Okay, accordingly decide the depreciation method. Wear and tear, that dependent usage, maintenance and care. Now obsolescence means changing the technology and legal limits. Certain time there's restriction. For example, we cannot use the, I don't know how much in your state, but we cannot use the car more than 15 years in some state. So my life cannot be more than 15 or like that. Okay, we have to review the residual value that here, because residual value useful life, because the amount of depreciation is going to be affected on the basis of changing residual value in useful life. Now when I have to start charging the depreciation commencement, start when the asset is ready for use. Okay, once it is ready for use in the manner which is intended by management. Method of charging depreciation, this is important, that is reflect the expect, this is important. Now, a pattern of the future economic benefit. So some people say, no, so excellent method. WDV method. Okay, might be have covered this SLM WDV method in your graduation or in the foundation that year. Okay, anyways, the pattern of the future economic benefits, no, they're not talking about this SLM and WDV. They say how much you're expecting to generate the future economic benefit from particular asset. This is the depreciation we are going to charge on the basis of future economic benefit. If there is a change in future economic benefit, for example, I am expecting that this particular machine is going to help me to do the production every year 20,000 units for over a period of 5 years. I will say charge SLM method that year. But if I say the future economic benefit change in future, so my method of depreciation is also going to be changed. Now that's why change in method of depreciation, we don't call it change in accounting policy, we call it change in accounting estimate, because I'm changing my method of depreciation. Certain people call it change in accounting policy, but you know that change in method of depreciation is not in change in accounting policy, we call it change in accounting estimate. The reason is that when I decide the method of depreciation, which is depend on the future economic benefit, now my future economic benefit is on estimation basis. If those estimation changes, so my method changes. So that's why that change in method of depreciation, we call them change in accounting estimate. Okay. Now they say change of method depreciation prospect. Whenever you change the method of depreciation, we have to give the prospective effect. Whatever we have done in the past, we don't care about that. We have to give them prospective effect. Now depreciation, when we do the revaluation, we have to charge the depreciation revalued amount over the remaining useful life. Now cease or depreciation, when we have to stop charging the depreciation or whichever happened earlier. Retire from the active use and held for sale. What is retirement? I will discuss with you, or if you have derecognized. Whatever happens, if you have retired the asset from the active use and held for disposal or derecognition. So what do you mean a retirement? First of all, that is in case of a retirement, we have retired the asset from active use. We are not, for example, this is the air conditioner in this room. I don't want to use that here, okay, and held for the disposal that here. So they say, as I'm not using it for providing the service or production of goods, okay, so they say in that case, that retirement asset we have to show separately in my balance sheet. Then they say that retirement asset, we do the valuation lower of the carrying amount NRV that year. And suppose my carrying amount is 10. NRV of that particular asset is 8. So lower is 8. So I'm decreasing the value from 10 to 8. So 2 will charge to profit and loss account. Okay, this is a retirement. And we don't charge any depreciation on that. Every year that year. If we have sold within the year, then that's a different case. If you have not sold after the end of the next year also, so what is going to happen? The book value again compare the NRV. Whichever is lower, recognize. Suppose from 8 it goes down to 5. So here I reduce by 2. Now here I'm to reduce by 3. And these 3 will go to profit and loss account. You got the point. So every year we have to compare the book value and the book value and the realizable, net realizable value. And if value goes down, charge it to profit and loss account. Okay. Now derecognize, we have removed from the books of account. Obviously, if we have removed the assets from the books of account, how will charge the depreciation on that? And difference will go to profit and loss account. This disclosure of AS 10 is not important at all that here. That is, but no need to even read it that here. Okay. But regular in EO batch, I just read it, but not at all important from the examination point of view. So what I will do that now, we'll cover the question. Very simple accounting standard. Now, I see favorite question is to ask a student to calculate the cost of PPE. Okay. Now, ABC Limited is installing a new plant at its production facility. It has incurred these costs. What are these costs? Cost of the plant, cost plus taxes. If those taxes are non-refundable, add to the cost of the PP. Okay, this is correct. 25 lakh. Initial delivery and handling cost, yes, we covered 2 lakh. Cost of site preparation, yes, 6 lakh. Consultant used for advice on the acquisition of plant, correct. Interest charges paid to supplier for, no. Remember that interest we don't add to the cost of the PPE. We don't add, except if it is allowed by the AS16. I know AS16 allowed to qualifying asset. Don't worry about all that, but interest paid to the supplier or for deferred credit, we have delay in the payment, so that's why the supplier charge interest. Okay, that is not a part of the cost of the PP, that will go to P&L. Estimated dismantling cost to be incurred after 7 years. So what happens? Rarely they will give the present value. This is the cost you will incur after 7 years, but AS tends to record the present value. If they have not given the present value, so we are going to record it 3 lakhs only. But if they give you the present value factor, so multiply with the discounting factor and calculate the present value and then add that. Operating losses, I told you that here, that is not a part of the cost of the PP. So here 25, 2, 6, 7 and 3. Okay, 43 lakh. Okay, 7 marks, you got 7 marks. Two things that what we have, I will make a separate video how to write the answer. So many students are asking. Okay, so those who are not covering it, we just have to make a note that interest, these two items is not a part of the cost of the PP as per AS10. Simple. Okay, now what to say that now Shrishti Limited contracted with the supplier to purchase machinery which is to be installed in its department A in 3 months. Remember, 3 months. Now a special foundation were laid down for machinery which were to be prepared with the supply lead time. Now the cost of the site preparation laying foundation, how much the cost of the site preparation? 1,41,870. So 1,41,870. These activities were supervised by technician during the entire period which is employed for the purpose, rupees 45,000 per month. The technician specifically belongs for that supervision. That is the part of the cost of the PP. 45,000 per month. For how many months? 3 months. So 45,000 multiplied by 3. So 45,000 multiplied by 3, that will come 1,35,000. Now they say the technician services were given by department B to A, which billed the service 49,500 per month after adding 10% profit margin. Okay. So what I told you that here, now that is a profit margin, we cannot add that here. Okay. So what is going to happen that here now? Just give me a minute that here now. Okay. Okay, that they have mentioned something about the per month 10% margin on that. The technician service given with okay, no, sorry. They're talking about this service only, this technical service. Okay, this is a 45,000 plus 10%, correct. That is coming 49,500. So this is not a part of the cost of PP. I told you, internal company transaction, only cost we have to cover. 45,000 multiplied by 3. Now we have already recorded this 45,000 multiplied by 3. The machine was purchased at rupees 1,58,34,000 inclusive IGST 12% for which input credit is available. So input credit is recoverable, then that is not a part of the cost of PP. So I will say 1,58,34,000 if it is 112 inclusive of the 12% GST multiplied by 100. So this much amount will come. Okay. If it is recoverable, that cannot be part of the cost of the PP. Now, an architect was appointed at what? 30,000 to supervise the machinery. 30,000 architect fees, architect 30,000. Hey, transportation, where's transportation? I missed the transportation. Okay. Now, 55,770 transportation charges were incurred to bring the machinery to the factory site. Yes, transportation. Okay. 55,770. Cost of the PP is this much. 7 marks is viewer. Okay. The next one is that. Very simple. You can do that. 29 is simple. Okay, let me read that. Okay. Cost of the PPC. The Star Limited purchase machine 6 lakh 80 inclusive GST of 40,000. Input credit is available. So 6 lakh 80. You can in here also you can show the deduction, but okay, 6 lakh 80. Then 40,000 they have deducted at the end because you are going to claim the input GST. Now site cost of site preparation, yes, 21,200. Now that 56,000 labor cost, but 200 out of the total 500 men's hours. Out of 500 hours, 200 is for that particular project. So if 56,000 is for 500 hours, how much will be for the 200 hours? That is coming 22,400. Okay. Now spare parts and tool consume in installation, that is how much that is? 5,000. Okay. For this particular PP. Okay. Now here salary of the supervisor 26, only 25% used for this work. So 25% of 26,000, that is going to 6,500. Now total technician expenses 34,110. That is 10% of that. That is coming 3,400. Now test run and experimental production run 18,000. Now here consultancy charges to architect, that is also part of the cost of the PP, 11,000. Now depreciation on asset used for installation. For this asset you use some other asset. The depreciation of that asset is going to add to the cost of this PP. Total 7 marks is here. Okay. Now last one. Now in the year 2016-17, entity has acquired a new freehold building with a useful life of 50 years for rupees 90 lakhs. The total cost is 90 lakhs at here. Okay. The entity desired to calculate depreciation. Okay. using straight line. It has the following component. Not there is no residual value of lift and fixture at the end of the useful asphalt. What is the life of the land? Infinite. Do we charge depreciation on that? No, no depreciation. Roof, how much the life is? A 25. So 10 lakh divided by 25. So here 10 lakh divided by 25, that is coming how much? 40,000. Now lift that here now. 20 years is the life. Cost is how much? 5 lakh. So 5 lakh divided by 20, that will come 25,000. Fixtures that here, life is 10 years. Cost is how much? 5 lakh. So 5 lakh divided by 10, that will come 50,000. Now last one is that remainder of building. 50 years is the life and the cost is 50 lakhs. So 50 lakhs divided by 10, not 10, 50 years life divided by 50, that will come how much? 1 lakh. So that is the cost of that is the amount of depreciation on the component basis. Do you remember I told you on the basis of life for the different part of the asset, we will depreciate accordingly. That is all about what? Accounting standard 10, that is property, plant and equipment that here. Okay, so we have done in almost 1 hour this PP, very important, but mainly instead of ask question on the cost of the PP, remember this chat. Okay, if you have any doubt, anything you want to tell me that here, you can drop a message in comment section. I will give reply there. That is for today. Take care all of you. Bye bye.